Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Aiman Hakim bin Muhammad RAZIF, student ID 62211124784. And in this video, I will talk about the Islamic financial product and services individual assignment.
For the first slide, we will explain about the Sharia compliance structure for the business financing product. First, we need to know what is our client needs before we can offer them the suitable Islamic financing contract. In this case, our client, which is our senior berhad, needs a financing amounting at a total of 500,000. Half of the financing will be utilized for equipment purchase, 150,000 for working capital, and the rest is for facility expansion purposes. Move to the next slide, we will discuss more details about the most suitable Islamic financing contract that seems appropriate for our senior berhad according to their needs. Murabaha is the most suitable contract for equipment purchase, and it literally means sale on profit. Under this agreement, Islamic Bank will buy the necessary assets that are required by the client, which is our senior berhad, like their production equipment and technological advancement, and resell them to our senior berhad at a cost plus sale and predetermined profit agreed by the two contracting parties. The second contract is tawarruk, or commonly referred as commodity murabaha. It means purchasing a commodity on deferred price and later selling it back with the intention to gain instant cash. These contracts are suitable for working capital and facility expansion, as they both need cash to execute it. Here is a simple terminology on how tawarruk works. A customer, which is our senior berhad, will approach an Islamic bank, which is us, for financing based on tawarruk concept. And then the documents will be submitted together with the application forms to Islamic Bank, which is us. Once approved, bank will buy commodities from broker A at 250,000 K. Subsequently, the bank will sell the same commodity to the customer at 300,000 K in deferred terms. The difference of 50,000 is the profit earned by the bank. The customer then will appoint the Islamic Bank as an agent to sell the commodity back on behalf of him for instant cash. Next, we will talk about the potential risks and challenges in Islam. The concept of risk in Islamic banking and finance can be best understood when viewed from two dimensions. A, which is the prohibition of gharar, and B is the freedom of contract. According to Sharia, gharar is any element of chance involving asymmetric information, uncertainty, risk, or even speculation that leading to illicit profit, such as excluded by the religious and consequently by the moral precepts of Islam. Islam offers full freedom of contract to economic agents as long as the resulting contract is within the boundaries defined by Sharia, which mainly exclude riba and gharar. Given the freedom of contract and the understanding of gharar, Islam fully recognizes risks generated by financial and commercial factors. The main and most significant risk that we can see is credit risk in murabaha, which is the potential default risk or non-payments by the customers and non-delivery goods by the suppliers. In this scenario, Islamic Bank will face the ownership risk once it bought the desired equipment by the client, until they transfer the ownership to the end user, which is our senior berhad. Ownership risk can be identified when someone purchased the goods and needed to bear all the risks and consequences of holding the object. Risk here means the goods in the inventory will be facing and vulnerable to a risk, and it also can depreciate in value, which is a market risk. So when someone owns the goods, it will face ownership risk, or also known as risk of capital. The second risk that might arise is operational risk, which means the potential loss resulting from inadequate or failed internal processes. Operational risk is often considered as a residual risk, given the fact that any risk faced by a bank that is not market risk or credit risk falls under this category. This risk arises from inefficiencies in fund utilization, delays in project implementation, or misuse of the fund from the management, and it is related mainly to the internal part of the organization. For example, if one of the top management embezzles the company fund for its own use, thus it will affect the whole organization because the actual purpose of the fund that have been allocated are not met. Last risk that can evolve is Sharia compliance, central to the credibility of the proposed financing. Non-compliance with Islamic principle, whether through errors in contract formulation, improper execution of transaction, or lack of adherence to ethical guidelines, can lead to the reputation damage for Islamic Bank. Such risks can undermine the trust of clients who prioritize Sharia adherence, potentially resulting in loss of business and legal challenges. Last slide is about on how we can mitigate the risk. To address the identified risks, Islamic Bank must implement comprehensive risk mitigation strategies tailored to the specific challenges of the proposed financing. The following strategies, supported by example from similar scenarios, demonstrate effective risk management approach. First is mitigating the credit risk. Awas Sdn Bhd can link the 500,000 financing to specific asset like machinery or inventory, ensuring this can be reclaimed if the company fails to repay. The company can also provide collateral such as existing equipment to secure the financing. A repayment plan that matches our cash flow will help avoid delays, and a repayment reserve fund can act as a financial backup. A detailed credit assessment, including reviewing our Sdn Bhd revenue growth and debt levels, will ensure its capacity to manage the financing. Regular monitoring through various financial reports and site visits will help identify potential repayment issues early and keep the expansion project on track. Next is the market risk mitigation strategies. Our Sdn Bhd should conduct a market strategy to confirm demand for its increased production and secure its position in the industry. Using Murabaha, the company can fix the price of machinery or raw materials to avoid price increases. Diversifying products and customers will reduce dependency on a single market segment, while maintaining buffer stock can handle any supply chain disruptions. Contingency plans for market fluctuations and yearly price locking in tawarruk transactions can also help to stabilize the operations. Last but not least, upholding strict compliance with Sharia principles is essential for maintaining the integrity of the funding agreement. The Sharia Advisory Board of the bank needs to perform frequent evaluation of all agreements, procedures, and the links to guarantee adherence to the Sharia compliance. Training initiatives for bank employees and continuous dialogue with our Sdn Bhd emphasize the significance of maintaining Islamic ethical principles, additionally guarantee the adherence during the entire duration of the financing. So that's all the explanation in this video, and thank you.